Welcome to the deep dive. If you're trying to keep up with digital finance, the week of November 24th to the 28th, 2025 probably felt less like a week and more like a month.
It was incredibly dense.
Right. We saw AI agents basically taking over enterprise systems, stablecoins shifting from just speculative assets to, official bank payment rails.
And at the same time, some really frightening fraud threats targeting the industry's third-party connective tissue.
That's really the core theme here, isn't it? This tension between massive innovation and immediate new vulnerabilities.
Absolutely. The speed is the story. New commerce channels like this agentic AI are being created so fast that they're forcing regulators and security teams to adjust their strategies in, well, real time. It's pure technological pressure.
And since staying compliant and current is it's non-negotiable in the landscape moving this fast, we want to give a quick shout out to our sponsor for this deep dive, PayAcademy.
Continuous learning really isn't optional anymore. PayAcademy is essential for getting ahead. They've just rolled out new courses like Mastering Regulation E, which covers consumer protection and electronic transfers.
Error resolution, liability rules, all that.
Exactly. And Navigating Regulation Z, which is all about truth in lending, credit disclosures, APR calculations.
And given what we're talking about today, their new course on fintech payment solutions, gateway management and QR code applications is going to be indispensable for anyone building or scaling modern payment systems.
Totally.
Okay, let's jump straight in. Section 1, payments and global partnerships. This week was all about how companies are using cards and payment rails to reach new consumers.
And the biggest strategic play we saw came from Klarna. They're extending their partnership with Blackhawk Network BHN to push hard into the U.S. gift card market.
So this means if you're on giftcards.com, you can now use Klarna's flexible payment options.
Pay in for, financing, all of it.
For digital gift cards from over 350 brands. And they're expanding this into Canada and France too.
What's really interesting to me, though, is the strategy. Are they using gift card rails, which, often have different regulatory treatment than direct credit?
To expand BNTL functionality without triggering certain rules.
It seems like it. It
Yeah.
offers huge scaling opportunities with potentially a lot less compliance friction. Very clever.
Meanwhile, the traditional players are focusing on inclusion. MasterCard partnered with Zenith Bank in Nigeria.
Right, for the essential debit card.
Yeah, and this is designed specifically for low-income earners who are basically locked out of formal banking. Simplified onboarding, physical or virtual cards. It's a huge step.
And then you have Block's Cash App, which is just completely redefining buy now, pay later with their new Visa Debit Flex card.
This one is fascinating. They're integrating Afterpay installments right into the debit experience.
But here's the twist, and it's a big one. They are ditching traditional credit scoring.
Intentionally. They're using behavioral indicators instead, real-time income, spending patterns, to decide who's eligible.
Which is a huge bet. I mean, it raises the question, does abandoning FICO scores expose them to unforeseen regulatory risk if there's an economic downturn and losses spike?
They're betting their data is a better predictor.
A bet that's relatively untested under severe economic stress. We'll see.
And beyond just consumer access, we saw infrastructure getting unified. Arrow partnered with DNA Payments
To create that single system for retailers, in-store POS, online, stock management, all in one. True omnichannel.
And solving a really tricky technical challenge, Imfly and Edian expanded their in-flight payment system.
So even when the plane is totally offline, transactions are queued up and completed in about 30 seconds. A huge improvement for airlines.
Speaking of infrastructure, let's shift gears to Section 2. This is the foundational work in global regulation and open banking.
The biggest, most fundamental change was the completion of the mandatory transition to ISO 2022 for cross-border payments.
SWIFT data showed something like 97% of payments were already using the standard. Now, that sounds technical. Why should our listeners care about an ISO standard? What does richer data fields actually do for a compliance department?
Oh, it's massive for compliance. Those richer data fields mean much more accurate, more efficient sanction screening. Instead of fragmented, incomplete info, you have standardized, structured data.
So fewer false positives.
Drastically fewer. It cuts down on the manual investigations that compliance teams are drowning in. It saves a ton of time and money, and improve security.
We're also seeing open banking really mature. Customers of 8 Swiss banks can now connect their accounts using Essex Blink platform.
All under explicit customer consent to get that unified view for budgeting and planning.
And Wise just keeps cutting out the middlemen. They became the first non-bank to settle payments directly with the Bank of Japan, connecting via API.
Which just makes domestic JPY transfers that much faster.
On the regulatory side, the EU reached a big provisional agreement on the new Payment Services Regulation, the PSR.
And the focus is all on creating a comprehensive anti-fraud framework.
Right, with preventative measures, mandatory info sharing between PSPs, required IBAN name checks for transfers. But what about the liability? Does this mean PSPs are now on the hook if they fail to use these tools?
Yes, that is the clear regulatory intent. The PSR establishes liability. Regulators are basically saying the technology to prevent this kind of fraud exists. If you don't use it, the financial liability is on you.
Forcing the whole industry to adopt better security.
Exactly.
Meanwhile, back in the U.S., the CFPB's work on the open banking rule, the 1033 rewrite, is hitting some roadblocks.
Mostly due to the agency's funding challenges. And this brings up that high-stakes question of data control. Banking groups are pushing hard for fees for data access.
Which the fintechs hate. They say it kills competition.
And the outcome here will really decide if data ownership truly rests with the consumer or if it just becomes another asset for institutions to monetize.
And quickly, a bit of good news on the bureaucracy front. The UK's FCA moved to streamline MiFID transaction reporting,
Removing some FX derivatives in EU-traded instruments. It's expected to cut industry costs by about $100 million a year.
Okay, let's unpack the most dynamic area of the week. Here's where it gets really interesting. The move toward agentic commerce.
We saw autonomous systems being deployed to solve huge institutional problems, not just for consumer convenience. Take Bezware. They launched Invoice AI.
Right, an agentic AI suite. It's designed to process invoices all by itself.
And it specifically targets the 40% of invoices that show up without a purchase order. It's a $549 billion blind spot in unmanaged spend. Having an AI read, code, and route those is a huge immediate win.
So the payments industry is scrambling to build the rails for this kind of automated buying.
They are. Checkout.com adopted the Agentic Commerce Protocol, or ACP. It's an open standard backed by OpenAI.
And it lets merchants offer instant, safe checkout directly inside AI platforms.
But not to be left behind, WorldPay introduced its own spec, the Model Context Protocol, or MCP, on GitHub.
And that's their response to the 44% of shoppers who say they'd use an AI bot to browse for them.
But this raises a critical question. Are we seeing convergence or fragmentation? You have ACP, MCP, and even EMVCo evolving its 3DS specs, all building payment standards for AIs at the same time.
If these agents are going to work globally, the rails have to be interoperable.
But right now, the industry is racing in 3 different directions to try and control the standard.
With technology moving this fast, the skills gap just gets wider every day. And this is why we need to remind you about our sponsor. If you're navigating new protocols, gateways, and autonomous systems, you should check out Paycademy.
Especially their new course, FinTech Payment Solutions, Gateway Management, and QR Code applications. Staying competitive means you have to invest in these new skills now.
Absolutely. Okay, let's transition to where the digital economy is most vulnerable. Section 4, fraud and security.
This week really highlighted the dangerous concentration of risk in the financial supply chain. A major story was the notification sent to several top U.S. banks.
JP Morgan, Citi, Morgan Stanley.
That their client data was potentially exposed in an attack on a company called Cetus AMC.
And Cetus AMC is a critical mortgage tech supplier. So this breach, which the FBI is now investigating, reportedly compromised things like Social Security numbers.
A huge reminder. The biggest risk isn't always a direct attack on a bank, but a targeted attack on the third-party vendors that everyone relies on.
That connective tissue.
Exactly. And fraudsters are getting more sophisticated. ACI Worldwide predicts a 25% spike in so-called friendly fraud.
Where legitimate customers dispute transactions.
Just between Thanksgiving and Cyber Monday, it's basically organized refund abuse on a massive scale.
And the battle against deepfakes is heating up. A regular study found that biometric verification is now the single most attacked point in digital identity checks.
Fraudsters are using AI-generated deepfakes, manipulated selfies, you name it.
So what's the industry's response?
It's a necessary shift to what they call orchestrated verification workflows. Instead of just layering different solutions, they're connecting document checks, biometrics, and behavioral data into one adaptive system to build a holistic profile of the user.
Trying to defeat the AI-generated spoofs.
And we also saw a huge win against organized crime. The UK's National Crime Agency uncovered Operation Destabilize.
$1 billion money laundering network.
That bought a bank in Kyrgyzstan and used a cash-to-crypto pipeline to clean illicit funds, reportedly to fund the Russian war effort, a stark reminder of the intersection between finance and global conflict.
But on the flip side, we saw institutions using shared intelligence to fight back. An Australian scam sharing network, backed by the big five banks, detected over $60 million in attempted fraud in just Q3.
And they reliably caught 70% of social engineering scams before the money was lost. That's a huge win.
Okay, shifting gears now to Section 5, crypto and stablecoin breakthroughs. The big trend here seems to be stablecoins moving directly into the traditional regulated financial system.
That's exactly right. Klarna, the digital bank, unveiled Klarna USD. It's their own USD-backed stablecoin built on Stripe's open issuance platform.
And their initial goal is just financial engineering.
Purely. They want to drastically reduce their internal costs for international payments.
And it's not just fintechs. Federal banks are following. Cross River Bank launched new infrastructure to facilitate stablecoin payments while staying compliant.
But the most consequential pilot came from U.S. Bank. They're partnering with the Stellar Development Foundation and PwC.
What are they testing?
Custom stablecoin issuance with a heavy focus on bank-grade consumer protections. Specifically, the ability to freeze assets and clawback transactions.
Why is that freeze and clawback feature so critical for regulators?
It's the single most important bridge. By giving the bank the power to intervene and reverse a transaction in case of fraud or error, a standard feature in traditional banking under Regi, they change the asset. It moves from being an unrecoverable crypto risk to a bank-grade instrument.
Which massively increases the chance of getting regulatory approval.
Immensely. And the UK's FCA is also preparing. They announced a stablecoin-specific cohort in their regulatory sandbox to start testing UK-issued stablecoins.
At the same time, digital assets are getting closer to everyday spending. Kraken rolled out the Crack card in the UK and EU,
letting users spend over 400 different assets and earn cash back. And Software also introduced a MasterCard debit card linked directly to a non-custodial wallet.
So you can spend USDC, but you keep control of your private keys. A nice balance.
And finally, on infrastructure, Coinbase acquired Vector, an on-chain trading platform built on Solana.
A strategic move to get deeper into the Solana DX ecosystem, which did over $1 trillion